Hey there, this is Nick from Income Digs. Welcome back. We're going to continue on with a detailed example of recording the purchase of real estate in QuickBooks Online. This is part 2, so if you haven't yet watched part 1, I encourage you to do that. We recorded the purchase of this property as a cash purchase. In this video, we're going to take it to be a little bit more complex. We're going to bring in a loan, we're going to bring in financing, private financing, some prorated rents, security deposits, all those things that come up when we purchase property. So I encourage you, there's a link to part 1 below. Watch that first and then carry on with this one. Now, if you're interested in all of this content on real estate accounting, we have plenty of videos online. Check out our course, Real Estate Accounting Bootcamp. It's an end-to-end monster of a course. There's really a lot of content in there. It's affordably priced and it really teaches you everything from beginning to end. So if you're a real estate investor or if you're a bookkeeper with clients who are in real estate investing, I encourage you to check out that course because it teaches everything in extreme detail with support from me. But let's get into our example for today. So we're going to continue on with the purchase of this property, but we're going to make some adjustments to the journal entry because we're going to tweak the deal a little bit. Now, in the last video, I demonstrated purchasing this property with cash, and I came to the table with like $600,000, and therefore I have a negative balance here, okay? So of course, we would have needed the cash in our account prior to making that purchase. We all know that, right? So probably what would have happened was, this $200,000 injection that I had would have been something like $600,000 or $700,000, okay? So we wouldn't be able to close on a property. We wouldn't be able to close on a property without having enough cash in the bank. So it would have looked a little bit something like this. And there we don't have a negative balance, okay? So what we're gonna do now, I'm gonna go to this HUD and we made some adjustments on it. The settlement charges mostly have stayed the same. We're gonna tweak those a little bit. We now are going to do it finance, which means we have a loan here. Okay, so $650,000 purchase. Notice my settlement charges are higher. The reason for that is we have some added expenses associated with the loan we took out. We took out a loan for 75% of the purchase, $487,000. So what I want to do is I'm going to go through the journal entry that we created in the last video, and we're going to edit it to now account for this new loan that we have here. We scroll down to the settlement charges. We have the same exact, I'm going to scroll past those for a second. We have the same exact title charges, okay? However, we also have an origination fee, an appraisal fee, some daily interest, and we might even have an escrow that we're required to do. So I'm just going to populate this with some numbers here, kind of completely randomly for now, but we're going to talk about escrow as well. Okay, so let's now adjust our entry to reflect this new purchase scenario. So I'm going to open this up to the left, open this up to the right, and what I'm going to do is I'm going to drill down into my balance sheet so that I can edit the transaction. So I'm going to drill down into that 162.5. There's my transaction. I can drill down into that further. It'll pop up my journal entry, and I can now make adjustments. Now, some of this doesn't need to change at all. The land in the building is not going to change. Whatever we determined on a cash deal, this is going to be equivalent. Same with these closing costs. That $6,400 is going to stay the same. Now, we might add to that, okay, because we obviously have more settlement charges, but we're going to talk about how we deal with that. Our property taxes are going to stay the same. Our purchase deposit stays the same. I'm going to get rid of this cash at closing. Like I said in the last video, I like that to be the very last thing that we do. Okay, so now let's go through and let's deal with this $23,405.82. If I scroll down to the second page, what is that from? Well, $14,000 of it is from an origination fee. So I mentioned on the last video that when it comes to either capitalizing or expensing our closing costs, anything that has to do with interest, taxes, or insurance, we can expense in the year it was incurred. Therefore, we're going to use an account for interest. Now, you could potentially have a origination fee separated out. In my opinion, there's not much value to that. Whether it's an origination fee or interest, it's all going to the same place. Again, talk to your tax professional, decide if you need it to be separated. I'm not going to. I'm going to debit $14,625. Okay. Now I have this $450 here as an appraisal fee. Now this $450 is only required because I'm financing the loan. However, in my experience, that appraisal fee is going to go more toward closing costs than to the P&L. So I'm going to populate my closing costs again here, and I'm going to put in this 450, and I'm going to put here appraisal fee. Remember to update your descriptions. So here, this 14,625, this is my origination fee. Points, right? Origination fee equals points. Scroll down here, I have daily interest. I owe 480.82. So again, just like the interest on the points, I have interest here as well. So I owe 480.82 daily interest. Okay. Now the rest, I've already dealt with those, so I don't really need to do anything with those. Let's talk about escrow. Okay. So not every loan, but many loans require us to put funds into an escrow account for taxes, insurance, and potentially a mortgage insurance premium. So how do we deal with that? Is it an expense? No. It's a common mistake to take this $450, $550, $450 again, that's a total of $1,450. It's a common mistake to put that toward insurance, toward taxes, toward mortgage insurance premium. At this stage, we have not paid for those things. It is an other asset. So we need to track not only our mortgage balance, but the balance of our escrow account with our mortgage company. And the very first step to that is to fund that account at closing. So what the bank is telling me here is that to close on this loan, they're requiring me to come forward with $1,450 to fund that escrow account. Okay, this is not an expense, but it does go to my closing cash. I will have that much less cash available to me. I need to come to the table with that much more cash to close. So we should have an account, kind of like our purchase escrow. We should have a tax and insurance escrow account, other current asset. If you don't have that set up, set that up. It's an other current asset, tax and insurance escrow. And we're going to debit that. You can do a line for each, or we can just take the total, $1,450. And in our description, we can say initial funding of escrow account. Okay, so that's our 675, 181.27. Okay, let's check our math here. And boom, right there, gross amount due from borrower, 675, 181.27, perfect match. So if your debits aren't equaling, then we have to look at, something's off here. Okay, and again, if it helps you to go line by line, that might be a good idea. That will help you identify any errors that you have. You can see I'm combining some stuff, and I'm doing that math internally. That's okay for me, but if you want to go line by line, go ahead and do that. Okay, now let's go to amount paid by or on behalf of me, the borrower. So this is like, how do I pay for this property? The first is that $20,000 deposit. That hasn't changed. Now, aesthetically, I like this to be below. So I'm going to click and drag this down because I like all my debits to be up here. That's $675. And now I start paying for the property. Okay, $20,000 was from my deposit. That hasn't changed. The biggest change here is now I have this big loan here, $487,500. So instead of coming to the table with all this cash, I've got a loan. So how do we track a loan on our balance sheet? We're going to use a long-term liability, okay? And just like we did for the fixed assets, for the long-term liabilities, I'm going to encourage you to try to keep these generic as well. So we might do an account like this, conventional loan, okay? Notice this doesn't say 123 Main Street conventional loan. It doesn't say Swan Street conventional loan. It's just generic. Conventional loan. I'm going to credit this $487,500. And this is my initial principal balance. Okay? That's all we got to do. Now we will also track the class on it. Now there's some other stuff down here that we didn't talk about during the last one. So again, adding some complexity to this deal. This is common stuff that we see. So one is, where on the front end we owed some taxes, we also might get a credit for some taxes, okay? That happens sometimes, right? So maybe the seller hasn't paid their taxes yet and we have to carry that burden. Therefore, it's prorated. Now, we won't have to figure that out. The attorneys are going to do that. The closing statement will be prepped for us. But seeing it here, we need to know how to deal with that. We debited property taxes on the front end here. Here we're going to credit property taxes. This is going toward the amount I owe, and it's saying I owe this much less because we're paying for taxes on behalf of that seller. Okay? So you don't need to worry about how it got there, but you can put that in. Okay, so there's my property taxes, looking good. security deposits. So this is a good one too. So if we're buying a rental property that's already rented, chances are the current owner, the current landlord has in their possession some security deposits from the tenant. Okay, and if that's the case, they need to transfer those over to us, because whenever that tenant leaves, if the property's in good shape, they're going to request that security deposit back. So they owe that to us. Now, that we're not actually going to exchange cash, but it's going to come off of what I owe them for the property. So we're going to have a security deposits account. This is an other current liability, okay? So this is a liability. We owe this money to our tenants, okay? $1,750. Okay. Now, similar to our security deposits would be prorated rent. Okay, so let's say we're buying the property in the middle of a month and the owner has already received rent for that month, but we own it for half of that month. We should get half of that rent. Okay, and that's exactly what happens with prorated rent. So we should have an income account for rental income, which I have right here, and we're going to populate that. We're going to credit that $465.25. Again, you won't need to do the math on these. You should probably do the math to check the work of those preparing this closing statement, but this should be all calculated for you based on the rental rates and the closing date of the property. Okay, prorated rent goes right there. Looks good. And I have 510-140 right there. And so now, last step, cash due at closing. So we're going to pull up our JMB checking account. 165.040.90, perfect. Cash due at closing. Awesome. I'm going to pop this open and be larger so I can populate my class. All right. Looks good. You'd attach the document there, save and close. Let's see how this reflects in my balance sheet. Okay, so my tax and insurance escrow. First of all, purchase deposit goes to zero again. Tax and insurance escrow is $1,450. Every time I make a mortgage payment, that's going to increase. And then every time my bank pays for my property insurance or my taxes on my behalf, it will decrease. And we have separate videos on exactly how that works. What we're doing right now is just funding this. I've got my land, my buildings, my closing costs changed a little bit. I added that appraisal fee there. I have security deposits as a liability, and there's my conventional loan right there. Okay. All looking really good, right? Now notice my net income goes way more negative. Why? Because I have those big origination fees and interest right there. I got some income, but I have some expenses, which is common. Okay, so let's take this example just a little bit further. I'm going to do two things. One, I want to talk about private financing. And two, I want to talk about construction escrow. Let's take the second one first. Let's say that we're taking a loan on a building and we need to do some work to it. Okay, so if that's the case, what might happen is we might get a loan actually worth more than the purchase price. So let's say that this property is worth $650,000, but we are getting a loan for $750,000 because we're going to spend $300,000 on a renovation. Okay, so let's say we get a loan for $750,000, but $300,000 is going to go toward a renovation. Therefore, my construction escrow right here, they're going to keep $300,000 in reserve for me. Okay. So if that's the case, this is probably what our HUD would look like. So how do we deal with that on our closing? So one thing that happens when I do this is my interest expenses change a little bit. So let's drill down into my journal entry and let's make some updates. Okay, so the first thing I want to do is I might not need to make many adjustments here. Let's just take this loan, $487.5. Let's make it $750. We're just copying what's here. Okay, $750,000. Now, the other thing that has happened is my settlement charges have increased, my interest has increased, so I'm just going to update those as well. So my origination fee is $22,500, and my daily interest is $793. 793.73. Okay. And there should be one more. Let me see. 22,500, 793.73. Okay. We're off a little bit. Okay. I'm just a little dyslexic here. 739.73. That looks a lot better. Okay, and then the last piece here of our debits that we don't have yet is construction escrow. So if I get a loan for more than like the property's worth, likely the bank will hold that money in a construction escrow account. Again, other current asset, just like our tax and insurance escrow, $300,000. Okay, and I'm going to bring that up. So now my debit's $983,315. Perfect. Okay. Okay, and now what we're looking at here is we'll go cash at closing. So JMB checking, I gotta hit this. So now I'm gonna do my JMB checking one more time, see if it populates correctly. 210, 674.81, perfect. Okay, so let's record that. Oh, I'm missing a class field right there. See, I like that warning a lot. Save and close. Going back to my balance sheet, now I have $300,000 in construction escrow. And so what will happen is I have the full loan here of $750,000, but I don't get to keep all the money yet. I need to renovate the property, and then they're going to transfer that money over to me as I make those renovations. Okay? And we have separate videos on exactly how that works. All right? The last thing I want to do here is I want to add a private loan to this, okay? So let's say that I don't have all that cash. I don't have that 210, okay? So it's common that we would get a private loan to help us fund that. Now, it might happen at closing, but it probably won't, okay? Usually, a conventional mortgage won't like to see another private note being filed on the same date. So it's probably going to happen separately. If it did happen the same time, you'd see it you'd show it here as a new loan. But again, that's very rare. So usually what happens is there's simply a cash exchange off of the books from the closing, where you're simply going to you can do a journal entry where let's say we got 210 at closing. Let's say I needed like 150 of that. You're going to probably get that money either like the day before. Okay, let's do like 9:30. Okay, so let's say that we get in our JMB checking account, let's say that we get 150,000. All right, now where did that come from? And you'd have private/hard money loans, again, as a long-term liability, and you could potentially track that by lender. Okay, so, Susie's my lender, whatever, lender one. Okay, and I'm gonna put in, let's make this larger. We don't need the closing statement anymore. Okay, business is our JMB. And Swan. Okay, so typically our private loans are going to be held differently. If our private loan was the only loan we were getting, then yeah, it's probably on the closing statement. But in this case, it's not. Save and close this. And so what that does is it shows now I have a private loan plus my conventional loan totaling $900,000 for this property. And it's worth $650. I'm putting $300 into it. So I kind of $50,000 or so came to the table with. All right, so we've gone through a few different scenarios there where we initially bought it with cash, then we did a conventional loan with us bringing a good chunk to the table, we added in our construction escrow, and we added in a private loan. Okay, these are all different scenarios, and there's so many more that can come out of this, okay? Which is why I encourage you to check out everything we have available at incomedigs.com, including our end-to-end course, Real Estate Accounting Bootcamp. We start from an empty set of QuickBooks Online. We work through the simple examples. We get complex. We get really complex. We talk about subject to. We talk about owner holds, 1031 exchanges. We talk about the other side of things too, refinancing, selling, all of that, all within that course. Really affordable with the Q&As, the community. I'm right there with you along the way. All right. Hopefully you found this useful. I wanted to really dive back into the basics and make sure that we're on the same page as far as how to record the purchase of property on your books. Be sure to check out all the free resources we have available at incomedigs.com, and I will see you on the next video.